Eric was a man who loved two things: his children and the construction firm he had built from a single truck into an empire. Ursai was widowed by his wife and had access to her estate tax exemption through portability. As Eric approached 70, he sat down with his attorney and realized he had a success problem. Between the business, his real estate, and a life insurance policy with a $5 million death benefit he'd bought years ago, his total estate was over the exemption. Eric, his attorney warned, you're well over the exemption. When you pass, the IRS is going to look at that $5 million insurance check as part of your taxable estate. They'll take 40% of it. You're essentially paying the government $2 million just for the privilege of dying with insurance. Eric didn't want his life insurance, money meant to provide liquidity, to be eaten by the taxes. He created an Irrevocable Life Insurance Trust. He thought of it as a legal box that he no longer owned or controlled. Eric transferred ownership of the policy to the trust. He appointed his attorney as the trustee. He knew he had to survive at least 3 years after the transfer for it to count, so he signed the papers immediately. Every year, Eric gave money to the trust to pay the insurance premiums. To ensure these gifts were tax-free, his lawyer sent crummy letters to his children, giving them a brief window to withdraw the cash, which they never did. For years later, Eric passed away. Because Eric didn't own the policy at the time of his death, the ILIT did. The $5 million payout didn't count toward his estate. Without the ILIT, the $5 million would have been added to his gross estate, triggering a massive tax bill. Eric had effectively moved $5 million off the books, saving his family $2 million in taxes and ensuring his life's work stayed in the family. In summary, an irrevocable life insurance trust is an irrevocable trust designed to own your life insurance policy so that the death benefit is not subject to federal estate taxes. Transferring your insurance policy to an ILIT and naming the trust as beneficiary has a number of advantages, including the following. First, the ILIT will remove the life insurance from your estate, assuming you survive the transfer by 3 years. Second, the trust provides a flexible tool for the management and distribution of assets. For example, the trust can be managed by a trustee and make distributions in the best interest of your family. Third, the ILIT can provide your estate with liquidity to pay taxes and administration expenses. Fourth, the insurance proceeds will be protected from your family's creditors.